So as we approach year end, like always, the largest research firms, which, the Goldman Sachs, JP Morgan, Morgan Stanley, they provide their 2022 forecasts. And I want to go over these forecasts with you, since I know many of you might not have access to the data. Maybe you'll hear a data point on CNBC or be able to read it. But, having access to these reports and seeing where they're coming from, I wanted to go over a lot of this stuff with you. And the reason is you need to pay close attention to what the sell-side analysts, these are called sell-side analysts, are saying about the economy, different sectors, and stocks, because that's usually the status quo. So if you can prove through your research that these forecasts are going to be wrong, and I'm talking about to the upside or the downside, that's how you make huge returns. Because by doing that, it means this data, right, if your research is correct, it's not being priced into the market. So a good example of that was, say, in February 2020. When I was reading the research analysts, this is why I became more and more bearish, because I felt like people weren't seeing what I was seeing and what I was hearing through amazing contacts and interviewing people in China and Italy. And again, this is before the markets crashed, right, because they were closed for COVID. So everybody thought it was going to be a quick downside followed by a strong rebound. And when I say quick downside, it was like Goldman and Morgan Stanley predicted, one quarter of weakness. They were comparing it to other past pandemics. And this turned out to be much, much longer than expected, right? Over 4 quarters, 5 quarters. We're still dealing with some of that stuff now, where we still wear masks and it's impacting the economy in certain areas, especially New York and California, and also international travel. I mean, this is still going on now, COVID, right? They said it was going to be like 1 quarter and we're going to be fine. For me, I thought differently, since China actually closed its economy. Apple, Levi, you're looking at all these major brands were closing in China. And this happened like the first week in February, 2-3 weeks before the market really started to crash. China accounts for 40% of the world's growth. We're trading at crazy, crazy valuations, very expensive valuations, which is fine. However, if you notice, right before that point, that last quarter going in, GDP was slowing. It was under 2%. So we're seeing a slowdown with premium prices. Now you're taking away the growth component of the world, out of the equation. They're closing their entire economy. So for me, I thought it was inevitable stocks fall much more than, that quick pullback. Some of them were saying, hey, we could see a 5-7% pullback. That's what they were predicting from the pandemic. And it turned out to be 30%, which is a little bit more than I expected. I thought we were going to get nailed, but not that quickly, 30%. Now, why did it fall that much? Because all the major institutions, they were on the wrong side of this trade. They were forced to adjust and sell positions while these positions were pushing lower. Think of like a short squeeze or something. If stock's going higher and higher, people are like, oh, we got to get out before it goes high, because, they're short. So that's what a short squeeze. That's GameStop, AMC, and all these things. But when you could look at these sell-side forecasts or any forecasts, right? If everyone's completely bullish on the stock, that means sentiment is very, very high. That's what we saw with what? We saw that with Peloton. We saw that with DocuSign. DocuSign fell 40% in one day. Tens of billions in market cap wiped out. So if you're doing your research and saying, wow, these guys who are all involved in this stock are wrong, either upside or downside, that's how you make the greatest returns. So I want you to pay close attention to these forecasts. They're very important, because if you can find a hole in their research, you could make very, very strong, exceptional gains. So starting with, Piper Jaffray just came out. They said they surveyed 91 chief investment officers across multiple verticals, primarily within North America. And this is all in technology. And they said overall 2022, the IT budgets are anticipated to be up over 5% year over year. That's a major, major increase, because they went up 5.4% in 2021, coming off of, numbers that people were worried about from 2020 and COVID. So despite the uncertainties, despite inflation, you're looking at the biggest technology companies in the world are still spending and plan to increase their budgets on IT, which is interesting. You look at Stifel. So they say 3 potential correction catalysts, and these guys have the biggest downside number on the SP 500. So you say 3 potential correction catalysts. So they say cyclicals versus defensive, and equities are extended. So basically they're saying money is rotating into defensive sectors of stocks. They also say the slowing global money growth, especially as the dollar rises and tightens liquidity. And also they're talking about China, because China, the past tightening, despite easing now late after Evergrande, weakens global growth. So they're predicting the S&P 500 would be in the low 4,000s by Q1 2022. Q1 That's, a couple of weeks away, starting a couple of weeks away, and that's 10% downside from the current levels. It's a pretty big number. Goldman Sachs says the risk of recession to appear low, continue to recommend high growth and high margin stocks. And they say as high margins are a signal of quality, indicate these stocks are likely to outperform their lower margin counterparts amid an uncertain macro backdrop and tightening financial conditions. So they see the S&P 500 going to 5,100 in 2022. That's about 10% upside. Just give you a little bonus here. Some of the stocks they like, what they're talking about, the high margin stocks, MasterCard, MP Materials, that's MP as a symbol, United Therapeutics, Universal Display, NVIDIA, Marvel Technology, Autodesk. Notice how many technology companies are on this list. These are usually high margin companies. Alphabet, Meta, Insight, Booking Holdings, so Palantir. These are some of the names that they like, high margin companies going into next year because, look, those are the companies that are going to have pricing power. JP Morgan, 2022, the year of a full global recovery, an end to the global pandemic, and a return to normal conditions we had prior to the COVID-19 outbreak. Their price target is 50.50. All right, 5,050. So we're looking at about 9% upside, pretty close to Goldman. So one of the things they do say is they say international equities, emerging markets, and cyclical market segments will significantly outperform and deliver 2 to 3 times higher returns in U.S. markets. That's a pretty bold statement. That's interesting. And then you have Morgan Stanley saying the surge in global inflation has investors fretting about future growth, but their economists say prices, those surges, that inflation is going to subside, making the way for 4.7 GDP growth in 2022. And yet, its price target on S&P 500 is 4,400, so we're looking about 5% downside. So let's throw all this, right? These are the expectations going into 2022. So let's put all this together and I'll break it down, show you what it means. If you take the highest and the lowest forecast, right, you're looking at 10% upside, 10% downside. I'm going to say from someone who's been doing this for a very long time, that's one of the widest margins you'll ever see going into predictions next year from major firms. You might have a boutique firm that says, we're going to crash 30% or whatever, it doesn't matter. But from these big firms, you see 3-4% returns and maybe 7% returns. I mean, outside of COVID, because we saw a massive decline followed by, all this money printing and stimulus and so those returns are high. But usually going back historically, 4-5% returns, maybe 8% returns, and maybe 2-3% to the debt. You don't see that big of a margin, right? It's a very, very wide margin. And what does that tell you? It tells you how much uncertainty we have in the markets right now and what we're going to see in 2022. So when I look at that data and I go over my forecast, this is my forecast. I think we're going to see at least 2 to 3 separate 20% pullbacks. And this is going through 2022. I think investors are going to try to buy the dip like they've been doing for 5 years plus, like buy. But it's a different market now. And when you have low interest rates, you have the Fed there to pick you up and everything's going to be okay and just throw money at everything and hand checks to everybody. Listen, buy the dip makes sense. It makes sense that a lot of these companies have premium valuations. It makes sense of how much liquidity is coming into the market, where we saw a record amount of deal flow, a record amount of, assets trading at record highs. It makes sense for those conditions. However, in 2022, we're going to see a fundamental shift. I say a fundamental shift because that's what we saw in 2020. It was a fundamental change in the marketplace. In other words, I'm not saying that the market's going to fall because they're expensive. You could say that for the last 5 years on a historical basis. Again, people weren't factoring in low interest rates and the Fed, and fiscal policy just throwing money at everything. So, you deserve stocks to be trading higher than the normal, which is probably 17 times forward earnings over the past 10 years. And we were trading at 2021 times forward earnings. So, but the fundamental shift we're looking at in 2022, okay, it's a different landscape. It's a different animal. So you're looking at the Fed that's going to begin raising rates. My forecast, at least 4 times. At least 4 times next year. They have to start. I mean, you saw Powell. You're going to see him Wednesday. He's going to talk about it. I mean, you're going to see tapering much, much faster than expected. You have to. I don't know if you saw inflation numbers. The CPI, I'll cover that in a minute. And the PPI just came out today. But the Fed's going to stop buying bonds completely in a few months, right? Why? Because it's been brought on by massive, massive inflation it needs to control. So you have the CPI up 7% year over year, which is a 39-year high, and producer price just came out today showing a near 10% increase in prices. We've never seen that in history, right? And I read that through several headlines, so you can double check that. But even if it's not, it's one of the highest readings that we've ever seen on producer prices. That's how much these prices have gone up. But comparing inflation, the CPI, to the 80s, right? Because that's where really compare it, 70s and 80s, which is, the 39-year comparison. It's misleading because the index is calculated totally differently now. In fact, over the past 30 years, the government has changed the way it calculates inflation, and that's the CPI, more than 20 times. Why do you think they're doing this? They're not doing this because we want to make it more accurate. No, absolutely not. You really believe that? They want to make it more? No. They want to show mild inflation since inflation is by far the biggest risk to the market. It's the one thing the Fed can't control by throwing money at it. You have to remove money from the system. You have to deleverage. But in the 70s and 80s, the CPI included housing prices. But now we use a non-market rent for owners' housing costs. That's what it is, non-market rent for owners. That's the housing cost. Also, today, the government makes the assumption that consumer spending habits change as economic conditions change, including rising prices. So if prices rise and consumers decide to substitute that product, whatever. Say I'm not buying a Snickers because Snickers are $3 now and they were $1.50, just saying. I'm going to buy M&Ms now. It takes Snickers off the list as its basket of goods it covers. Think about that for a minute. This way, it's not going to report those higher prices for that product. So I'm not sure how you measure inflation then. But if you're looking at apples to apples comparison, or the way we calculate inflation in the 80s, right? And if you compare that to today, inflation, the CPI, is at higher levels than it was back then. Much, much higher levels. Right? We're at 7%. You want proof? I mean, it's not too difficult to find it. I mean, you can find it almost any place. But if you're looking at a basket of goods and how much these things have gone up, just look at used cars. You could look at, which are up 30%. You have beef, which is up 24%. You have gasoline up 51%. You have rental vehicles up 40%. Furniture up 12%. Bacon up 20%. Gasoline, again, up 50%. These are the numbers that you're seeing. These are the numbers that I'm seeing. These are the numbers that, for some reason, the Fed's not seeing. But for you to say that consumer prices are up only 7%, it's absolutely insane. You're basically, the Fed's calling us a bunch of idiots. But they do this because that's the new way they calculate CPI. And it's not really that new, but that's how they changed it over the years. But going into next year, where I'm going with all this, you need to be concerned. We had strong returns in the market for 3 straight years. I mean, 31%, 18%. What are we up now in the S&P 500? 24%? Something around there, 25%? The market usually goes up 8% annually every year. And I get it, why it went up so much. And, those are reasons why we were bullish for so long. But now, with this fundamental shift, the changes in the marketplace, I mean, these changes, we're going to see leverage come out of the market with the Fed tightening and tapering. Inflation is going to continue to rise as companies are under incredible pressure to report higher earnings every single quarter. That's your job as a company. Every single quarter, we need to grow, 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 grow. You know why? Because if you miss, with the valuations that they're currently trading at, if you miss, you become DocuSign. You lose 40% in a day. PayPal, down 40%. Peloton, down 50, 60%. So what does that mean? They're forced to raise prices. Some companies are going to get away with it. Large technology companies will be fine. They all have trillion-dollar valuations. They control the world. They have pricing power. But how many companies are going to be able to continue to raise prices to the point where people are like, all right, I'm done. I'm not going to Chipotle anymore. That used to cost me $7, $8 for a meal, and now I'm paying $12, $13. I can't afford it. I can't afford it for the whole family, and I get it. But when these companies are raising prices, it's going to create even more inflation. And then you throw in the new variants of COVID, which are going to come out forever, and how the government reacts and the media reacts. I mean, that just creates another layer of uncertainty, which we know uncertainty is terrible for stocks. That's what we're seeing right now.